As we look at the Hong Kong property market, we're seeing it sag. So far this year, down about 7% year to date. That's down 20% from the peaks that we had back in 2021. And even the spicy cooling measures that the government imposed for decades, some of that has been removed. We've got some of the stamp duty cut in half to 7.5%. But that begs the question for some, well, should we hold out longer for the government to get rid of it completely? We're now looking at HIBOR at a 16-year high. This is despite the Fed already indicating that they are on pause. So in this environment, is it better to rent or to buy? This is what Peter Churchouse had to say.
If you're an investor, you might have a different view to if you're a potential homeowner looking to move in to your own home. And with property prices down 15 to 20% in Hong Kong, if you're looking to buy and can afford to pay the mortgage and pay the down payment, prices down this much, it's probably not a bad time to look to be buying. And particularly given that in Hong Kong, it's very difficult to find the property that you want anyway as a homeowner for your family. If you find what you want, it's probably not a bad place to be looking right now. There's still a little more downside risk, perhaps, we think, over the next few months. But perhaps the worst is over in the fact that we've seen 15 to 20% downside since the peak.
What would your advice be to first-time home buyers? What are the most important considerations?
The first thing really is to be able to be sure that you can afford to service the mortgage. You must be confident that you can do that because if you find in 12 months or 18 months' time you can't, you're going to lose a lot of equity that you put in. So that, I think, is the first consideration. And the second consideration really is to think, does this property suit my needs, either as an investor or as a homeowner? And does it satisfy the needs that I have as a family with my kids and so on? So if you can satisfy both of those, it's probably not a bad time to be looking in this market right now, as some other markets around the region where we've seen prices come off a bit as well.
Let's talk a little bit about that. Around the region, where are you seeing that's good?
Well, put it this way, if you look around the region, buying in any other country around this region is fraught with all sorts of difficulties of legal issues. You're not allowed to own landed property in many countries. You have to be a resident or a permanent resident or an employee to actually buy property of any kind. And often you can't own property as an investor. You can't just go in and buy a house, not occupy it yourself. So there are all sorts of banana skins there. Hong Kong is probably the easiest place in the region to buy, and I would think that Japan is probably a pretty close second.
Would this be a repetitive question if I asked you about investment yield? Where are you seeing that best?
Well, the yield, if you're looking at rental yield, Hong Kong is not the place to look for rental yield. The yield today is less than the cost of capital, less than the interest rate you're paying on your loan. The best yielding markets in this region, I tend to think, are Australia and New Zealand. You can often be looking at yields, whether it be residential property or commercial property, of as high as 6, 7, even 8%, or maybe even higher. Certainly in Japan also, it's not uncommon to find investment yields of about, rental yields of about 5 or 6%. And that, bear in mind, is an environment where the interest cost is very, very low. So you can get a rental yield that is higher than your interest cost in Japan. So that's quite attractive to certain investors.
Bringing the conversation back to Hong Kong, recently the government cut the stamp duty in half from 15 to 7.5%. This failed to fuel the market or boost it. Does that mean that some are holding out for the government to do away with it completely?
Well, I think very much so. And let's face it, Hong Kong and China is investors love to unlove China and Hong Kong right now. There's not really a lot of foreign investment appetite, either for hard assets in Hong Kong, and that's reflected also in the stock market, where we can see listed property stocks are trading at some of the lowest valuations we've seen in 20 or 30 years. So foreign investors really have got the axe in for Hong Kong and China right now. I think also domestic people are worried that perhaps with a recession likely to hit us in the coming year, that perhaps they're concerned about jobs, their income, and they don't want to take on those extra financial burden of buying property if there's going to be some sort of risk to their job and their income going forward.